his team earlier this year that failed to push him ahead of Joe Biden. Plus, Biden's campaign and other Democratic entities have outraised the Trump campaign in recent months. Now, President Trump is threatening to curb the U.S. economic relationship with China, and he's promising to punish American companies that do business there. The president's calling on those firms to be banned from getting federal contracts. He also wants to impose tariffs on companies that leave the U.S. to create jobs in China and elsewhere. President Trump said that if Joe Biden is elected, China would own the U.S. Now, in California, the electricity crisis is getting even worse. The state's biggest utility says it expects to cut power to 500,000 people this week to prevent live wires from sparking wildfires. Last week, the problem was a heat wave. This week, California is expecting high winds to come sweeping off the Pacific Ocean. And Kamala Harris has made her first solo campaign trip as a Democratic vice presidential candidate. She went to Milwaukee, where she appealed to communities of color that will be crucial to winning the battleground state of Wisconsin. Harris met with black business owners. She also talked with Latino activists who support frontline workers. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine, Tom.
Leanne, thanks so much. Some nice cross currents in the market. West Texas Intermediate, we're going to get a 37 print there in a moment. There it is, 37.94, down 5%, make it 4.6% on oil. That's an important statistic. Dollar strength as well. And the NASDAQ market right now, and of course, this is coming off the SoftBank derivative exercise, whether you call it the NASDAQ whale, the gamma whale, you have to unwind the trade. The unwind intraday is tangible, 2.2% down on futures, NASDAQ futures. They were worse earlier. Right now, negative 29 on S&P futures as well. Earlier this morning, the bond market was quiescent, not now. The 10-year yield in a solid 3 basis points, 0.69%. That's not breaching any kind of support, but nevertheless, yield lower in the 30-year bond. Excuse me, 1.43% as well. Curve flattening this morning as well. Tomorrow, Reed Hastings will join the gentleman from Netflix in conversation with David Rubenstein. This is an important, timely interview. Reed Hastings, no doubt, will speak on leadership and management as well. Wednesday at 9 p.m. This is Bloomberg. Stay with us.
see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Good morning, everyone. Bloomberg Surveillance, Francine Lacroix and Tom Keene. We welcome all of you on a most interesting Tuesday. No question about that. With futures at negative 28, NASDAQ futures really deteriorated a solid 2.2% on the NASDAQ change, a negative 258 points. We were down near negative 300 moments ago. Right now in China, and there's any number of ways to take it, and the first thing to do is have someone qualified, as we do in Dr. Murtha. Andrew Murtha is at Johns Hopkins in their SACE school, where he is vice dean. He is definitive on the complexities of Cambodia and, of course, how it folds over to China as well. Andrew, I gotta admit to you, I actually took in Mulan this weekend, the new Disney epic, and I was crying at the end and all the beauty-tude. And to me, it is absolutely perfect Disney of what China would like to be. How far is China removed? How far is Beijing removed from the imperial China of Mulan?
So it's a great question. Unfortunately, I watched it over the weekend with my wife and daughter, and I fell asleep during the second half. So I'm gonna.
It all ends up happy.
Well, what we're seeing is tendencies towards China hedging its bets in terms of its interaction with the rest of the world looking long term. I mean, there's this talk of a dual circulation strategy that they call it, which focuses on kind of balancing away from global integration and more towards domestic reliance, which I guess is how things were kind of traditionally in the days before globalization. It's a worrying trend because I don't think it's going to be a happy ending for everybody, particularly the Chinese.
It may not be a Disney ending, but it comes up to the pregnant question. Witness the uproar this morning about the filming of Mulan in Western China. How do Apple, how do Disney, how does American business do business with China in this new international relations we have?
I think they really have to find the areas where they can operate without, on the one hand, the Scylla of China putting more restrictions on their ability to develop whatever product they're developing, and the Charybdis of the U.S. Threatening sanctions not too far off in the background. So it's getting a lot tougher than it was just a year or so ago.
Andrew Murtha, is there a belief in China that if there's a Biden administration, things will get a little bit easier on the trade front, or will it be more of the same?
It's a great question. I think that on the one hand, they will appreciate what is likely to be a more predictable relationship. That is to say that, like everybody else, they're not going to be awakened by tweets early in the morning. On the other hand, China traditionally prefers to work with Republican rather than Democratic administrations. And my sense is that the Chinese feel that although the Trump administration is somewhat of a wild card, even almost 4 years into the term, that the Biden administration is likely to be tougher on issues like sanctions against the kinds of things that China is doing in places like Xinjiang, and then increasingly in places like Inner Mongolia.
Andrew Murtha, thank you so much for joining us today. He's, of course, of Johns Hopkins University. Now, coming up next, Billy Holt, TradeWeb Markets President. We'll talk about working from home or going back to the office. This is Bloomberg.
we are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revisions.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Wall Street slowly moving back towards normal working arrangements. Yes, JP Morgan is doubling down on the proportion of investment bankers coming to its New York and its London offices. Now that the U.S. Labor Day holiday has come and gone, many employees are anxious to hear what's next. Well, Bloomberg Wall Street correspondent Sonali Bazak joins us now with Billy Holt, president of TradeWeb Markets. So thank you both. I mean, there's so many questions, and Billy, even here in Europe and in London, everybody wants to know, I mean, can they continue working from home? Are you expecting your people to go back into the office full time?
We're gonna try to be very, very flexible on this issue. It's a big issue. Here we are, kind of the Tuesday after Labor Day weekend in New York, and there's a lot of enthusiasm to get back in the office. I think everyone misses each other at TradeWeb to start with, but we're going to be, safety first, and that's how we approach this from the very beginning. And I think a lot of the eyes are what's going to happen with the banks, and I know that's part of our conversation today. But we're going to stay flexible as a company as all of this continues to develop.
Billy, if everything was working so well online for the whole year, why is there such a rush for the banks to go back?
Culture and tendencies is a really strong thing on Wall Street. And the culture around Wall Street, particularly fixed income trading, has always been a culture of showing up. You never wanted to get into the office or get on your trading desk after your boss arrived. You never wanted to be the first person to leave on a Friday afternoon. You always wanted to show up. So there's the optics around all of that, which has always been really important. And then I think there's also been a reality that the density of a trading desk has always kind of worked in terms of how, the workflow of trading situations and the risk of trading situations have always occurred. There's been something about sort of eye-to-eye contact and the trust around eye-to-eye contact that has always been sort of first and foremost in terms of the habits of the Wall Street trader. Those are really strong kind of parts of, I think, trading DNA. And so I think there's enthusiasm amongst the banks to kind of get back into the office and sort of get around each other and sort of have a little bit of a galvanizing moment. This has been a very kind of traumatic and sudden thing across all the different industries.
So, Billy, there's got to be a point also when banks turn around and say, listen, we did all of this online, let's start realizing some efficiencies here. Are traders worried that the fixed income businesses in particular can start to shrink in terms of headcount in the next couple of months?
I think, listen, I think we've been through those thought processes before. And if anything, I think one of the things that's really interesting is we had some time for sure in March and in April where there was all of this sort of electronic volume that was happening in fixed income, and TradeWeb was very lucky, and we're really proud that we played a leadership role around that. And there was, as you know well, a lot of very strong profitability amongst the banks around the trading businesses. So I think that was a moment in time where we saw something happen, which was markets can move more efficiently and banks can become even more profitable than ever. So from our perspective, they can really live together. And I think we saw that happen in March and April, and I think that was a really good outcome in general for the marketplace.
But Billy, when do you see people going back to the way we used to work in let's say, December 2019? I mean, 5 days a week, back in the office. Will we ever go back to normal, or is it going to be just more flexible working days and working hours?
We've learned something, I think, very important over the past 5 months, which is kind of, it's interesting, right? Almost nobody knows anything. So it's impossible almost to know how this will wind up kind of all evolving. I would say there's enthusiasm to get back to the office. Will it be exactly the way it was? That's hard to say, because I think you're right that we have learned a lot over the past 5 months, and some of those things that we've learned are going to be applied. There's going to be a more efficient approach to all of this. The enthusiasm is there, but it's hard to know exactly if it will be the way it was back in December. To your point, it's hard to see that, actually.
Billy, the irony here is that fixed income traders are going back to less work than they had the last couple of months. What's your expectation for the next couple months in terms of fixed income trading volumes?
I think there's a pretty decent chance things are going to get busy again. We obviously have a very big election coming. I think we're going to start to see a more busy and more active marketplace. And I think the instinct is, as people maybe begin to arrive back into the offices, I think the sleeves are going to get rolled up and we may be headed back into an interesting marketplace.
A huge thank you to Billy Holt there of TradeWeb Markets, and to Bloomberg's Sonali Bazak for bringing us that great conversation. Now, a disclaimer for our viewers: Bloomberg LP, the parent company of Bloomberg News, does compete with Thomson Reuters and Refinitiv in providing news data and information to the financial industry, and Refinitiv holds a majority of the combined voting power in TradeWeb. Now, coming up a little bit later today, we speak with Valdis Dombrovskis. He's the European Commission Executive Vice President, newly minted Trade Commissioner to replace Phil Hogan. That was announced a couple of hours ago, and I think we have the first interview with Commissioner Dombrovskis. That's at 11:30 a.m. New York time, 4:30 p.m. in London. Technology stocks leading a sharp drop in European stocks. Futures on the Nasdaq also pointing to fresh losses on concern that valuations have reached extremes. The other story we're watching out for, certainly here in the UK, but also overall in the FX market, is the pound sterling weakening quite significantly for a fifth day amid fears of a hard Brexit. Now, coming up next, join Tom Keene, Jonathan Farrow, and Lisa Abramovitz for more Bloomberg Surveillance, simulcast on radio and TV. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety.
Term is not looking good right now in terms of the support for consumption.
This economy is dynamic, but not dynamic enough.
Doing too little is clearly the problem. It's hard to see what the consequences are of doing too much.
I think we're all focused on that September Fed meeting.
We are seeing an income crisis. We are seeing inaction from Washington, D.C., and we can't afford to do this again.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From London and New York, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Tom Keene, some stormy weather in Longsville in more ways than one. Summer's over.
Summer's over with a vengeance, John, and we've seen a real deterioration in the last hour. The bond market joins the NASDAQ carnage that we've seen. John, I can't emphasize enough over the last 5-6 days the importance of this NASDAQ, Tesla, Apple story. It harkens back so many times to derivative excesses. And, John, we've got the right guest coming up on this.
Looking forward to catching up with Stuart Kaiser of UBS. Tom Keene, equity futures down, NASDAQ futures down and down hard off 220, down by 1.9%. Key question for the next couple of days, Tom, never mind the next couple of hours. What on earth is SoftBank? Is it a hedge fund? What is it now?
John, this is absolutely the heart of the matter, folks. This is real simple. It's a publicly traded company acting in an investment capacity. This, of course, beautifully done up by the FT and Zero Hedge out of Abu Dhabi, ex-Deutsche Bank guys, et cetera, et cetera. But you're right, John. Is it basically a publicly traded hedge fund where people now are seeing the unwind of a very successful derivative strategy?
Tom, you mentioned the bond market. There is a bid into the Treasury market. Yields are lower by 2, 3, 4 basis points at the long end of the curve. And Lisa, a little bit of supply a little bit later.
This is the tension, right? You've got the safety bid into Treasuries, but you've got a supply deluge that we don't know how big could it get. We're going to be getting a $50 billion sale of 3-year notes today. That is a record. That's at 8:30 Eastern. Very much curious to see how much there is in terms of organic demand for this offering. Then also today, UK's chief Brexit negotiator David Frost is meeting with Michel Barnier to try to forge a deal before a key October 15th meeting with EU leaders. I bring this up so that Tom can ask John all sorts of questions about Brexit, which I know John loves to answer. And then at 3 p.m., Senate is going to be returning with the goal of eventually voting on a stimulus package. To me, and Tom, exactly to that point, this to me is one of the most interesting aspects of the past few weeks. There has been a shift, John, away from talking about the inevitable of this deal getting done to now saying, you know what, the likelihood of any deal getting done is getting smaller and smaller, especially as the data comes in a little bit better than expected.
Lisa, let's avoid the Brexit conversation at least for an hour. Just give me 60 minutes just to catch my breath and get used to talking about something else, okay? Let's talk about the fiscal effort down in Washington, D.C. Tom Keene caught up with Larry Kudlow, National Economic Council advisor, after those numbers came out on Friday, the payrolls figures, and I basically asked him, is he comfortable if they don't have a fiscal deal before the election? And he said, we can live with it. we can live with it, Tom. That's the administration stance at the moment, going into September, October, and heading towards that election.
It's 55 days to the election. Kevin Cirilli, I thought, was really good this morning, John, about recalibrating here after Labor Day. Do we need a stimulus or not? I'm not going to answer the question. I'm going to go to Greg Valliere this morning. John Farrell, Mr. Valliere suggesting only 10 to 13% of America is undecided. John, I've never seen that.
Let's get to the price action at the moment as well, Tom. Equity futures down, the S&P 500 off by around about 0.5%. Here's the move, though. NASDAQ futures down 213, off the lows for the session, but negative 1.85%. Interesting ECB meeting on a schedule in the diary this Thursday. BMO, Stephen Gallo saying it's a tricky one for Christine Lagarde. We'll try and touch on that a little bit later. And as you bid into the bond market, yields lower by 2 basis points to 0.69%, just south of 70 basis points on a US 10-year. It is the story of the moment. What is happening with big tech and what is happening in the options market? The perfect guest to kick things off this Tuesday morning, Stuart Kaiser, UBS head of equity derivatives research. Stuart, let's keep it super simple. What's the message for the clients, given what's going on right now and over the last few months?
Well, I think you can interpret this two ways. And good morning. Thanks for having me again. The first is that this is sort of, the last gasp of the tech rally, and people are sort of, chasing the last legs of the rally and hedging, and this is sort of the thing you needed to worry about in terms of large cap tech leadership and quality leadership. I think the flip side of that is that this is sort of a healthy correction, and you've seen across the board in the option space activity that could be read two ways. It could be read as people are chasing the rally by buying call options, or some of the other flows we've seen is stock replacement. So people selling out of stock and replacing that with calls as a way to reduce risk. And I think, depending on which side of that ledger you are, you're going to have a slightly different view of things. Either people are sort of piling into the tech trade, or people are saying, wow, we've had a really strong rally here at the end of the summer. It's prudent for me to reduce some risk ahead of some key upcoming events. And that's how I'm approaching things. So from my perspective, we still think large cap tech leadership, or what we would call selective cyclicality, is sort of the way to be positioned. And this is probably a shorter term disruption for the markets. But, I think you need to respect the fact that we've seen in 2 weeks, 1.6 million contracts added in the big 5 tech stocks, and 70% of that's been in call options. And when that kind of flow goes through the system, it's going to impact the way markets trade.
Nicely said. Stuart Kaiser, let me ask the question, and we do quantitative finance, folks, on Wednesday, so we're going to keep it simple on a Tuesday. Stuart, real simply, is there a way to know when the excesses of a SoftBank trade are done? Can you observe in the market when it's over?
Well, look, the positions are in place. So, and I'm not going to speak to any one client because I think we've seen these flows across, other investors as well. So the positions are in place. And the question is, there's two ways that can come out of the system, right? They could unwind the trades, which I think is probably unlikely in the near term, or the other side of that trade, which is the bank trading desk can adjust their risk so that those positions aren't as disruptive to the markets. And probably what we've seen the last couple of weeks is that second thing going through the system, which is these desks that ended up on the other side of those trades, need to risk adjust their positions. And that's an ongoing process. And I think when that process is happening, you see what we've seen the last few days, which is a lot of volatility. So unfortunately, in a circular way, the market's calming down is going to be when we see that. A couple ways to look at that are, number one, we look at the ratio of NASDAQ to Russell implied volatility, for instance. And NASDAQ volatility is about 1.2 times as high as Russell, which, given the growth risks, we would consider, not normal. And the second is just, where is NASDAQ implied volatility relative to what the market's been realizing?
Stuart, look, you absolutely nailed this. And that SoftBank's out there as the buccaneer. I don't know who regulates them. John Farrell mentioned that earlier. And I want to go to Taleb's first book, Fooled by Randomness. The bottom line is we're all fooled by SoftBank right now. What will global Wall Street do on their desks to adjust to this derivative shock?
Well, I think what we've seen is, a lot of these single stock options positions have forced the market to use NASDAQ and the index level to hedge that risk. And that's what you're seeing in the market today is people ended up sort of quote unquote short gamma, pardon the phrase, And what that does is just it makes the market much more volatile when you get large moves. So what the street is doing is they're using the NASDAQ and they're using cash positions to try to reduce this risk as much as they can. But that's a turbulent process. So I think, what we're seeing is essentially a 7 or 8% drawdown now off the NASDAQ highs as the street tries to kind of absorb and redistribute that risk across the street. It's going to take a little time. And, relative to the rally we've seen, the pullback isn't that large. But people get used to coming in every day and seeing NASDAQ up 5 weeks in a row. And this stuff becomes, much more emotionally painful than I think it is for P&L. So, I think this is just a process the street's going to have to go through to digest those large positions, unfortunately.
More emotionally painful, does it also change the psychology of individual investors? The idea that buy the dip may not work every time. Looking at an Amazon share down nearly 3% ahead of market open with no discernible news at a time when people are counting on Amazon to rule the world.
Yeah, I think it does change the market mentality. 5 weeks in a row, NASDAQ up, those stocks, the single stocks, large ones, Amazon, Apple, Facebook, Google, et cetera, have just been easy trades, right? You just sort of buy them. If they trade off at all, you add to that risk and you just kind of, set it and forget it, as it were. So yeah, I think it does change the mentality a little bit because it had been an easy trade. Now it's become a harder trade. Retail money is either fast money or really slow money, right? So if retail is buying at the bottom and they're buying stocks they like that they plan to hold for a decade, that's slow money and it's really healthy for the market. If retail becomes fast money, and that's sort of the dynamic you see in China, then you get a very emotional market that has a lot of short-term volatility and trading action. And I think, the last week or so we've been in that second case, where retail that thought they could just buy these stocks and just go about their business has now been reminded that there's risk in them. And, you mentioned Treasury supply, you mentioned the ECB, we've got the election, we've got the FOMC. From an institutional perspective, these are real risks that need to be managed ahead of time. So I do think it changes the mentality of the retail investor in particular, as well as some of the long-only community as well, I would say.
Stuart Kaiser of UBS. Stuart, always great to catch up with you, sir. Stay well, won't you, as we approach the back end of the year. Summer is truly over, a theme we'll stick with through today and over the next couple of weeks. Tom Keene, I just wondered, the crowd, it's constantly refining the narrative to fit the price, and I love the way you've put it. Fooled by SoftBank. How many people came up with elegant, nice, finessed arguments as to why we had that huge surge in August, only to see it reduced down to a monster, SoftBank acting like a hedge fund and buying up a load of bullish contracts.
The numbers here, John, are worth repeating, and thank you to the FT and Zero Hedge for really great work on this. 30 billion notional, which is the printed value of the derivatives, but the cash in is believed to be $4 billion. They made roughly 100% on the trade, but those are ginormous numbers, John, and now they got to unwind the trade. Who pays that bill?
And try and realize some of the gains as well. Lisa, you said something last week that turned out to be profound. Are we seeing a reality check? Lisa, do you think we've seen one now?
This is hard to say it's a reality check given how much the shares have gotten pushed up. And still, I don't really see any discussion about fundamentals. I don't hear people saying what the correct valuation of Amazon, of Apple are right now, given where we are with rates. This is the biggest conundrum to me at a time of so much technical disruption with the likes of SoftBank, John.
Trying to justify the unjustifiable. The effort, I'm sure, continues around the world looking at this market. Equity futures down, NASDAQ futures down a little more than 2%. S&P 500 futures negative 0.6%. As we get the week started stateside for our audience worldwide, this is Bloomberg Surveillance. Up next, Subhadra Rajappa of SocGen.
With the First Word News, I'm Kaylee Lines. Bloomberg has learned that President Trump has discussed spending as much as $100 million of his own fortune on his re-election campaign. It would be unprecedented for an incumbent president to put his own money towards winning a second term. The president scrutinized heavy spending by his team earlier this year. Plus, Joe Biden's campaign and other Democratic entities have been raising more money than the Trump campaign in recent months. Drug makers racing to produce coronavirus vaccines have come out with an unusual public letter. In it, they promise to avoid shortcuts on science as they face pressure to rush a shot to market. The CEOs of 9 drug makers signed the pledge, among them Moderna, Merck, Pfizer, and Sanofi. Meanwhile, President Trump is hinting that the U.S. could approve a coronavirus vaccine in October, just before the election. China is proposing global data rules to counter U.S. moves on TikTok. Beijing outlined a slate of proposals designed to prevent foreign governments from acquiring data stored locally. The U.S. has accused services like TikTok and WeChat of sharing information with the Chinese government. And shares of Tesla are falling today. The electric car maker was widely expected to be named to the S&P 500 on Friday, but it didn't happen. The decision may have rested on questions about Tesla's profitability metrics and murky full-year forecast. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lines. This is Bloomberg. This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
The tech sector is undergoing a correction right now, and as you well know from your coverage down through the years, that's a fairly normal item. I don't think anybody should panic. The economy is definitely improving.
Larry Kudlow, White House National Economic Council Director. No sign of urgency, no sign of concern over the market rout as far as the fiscal stimulus package is concerned, and no sign of real talks at all over the last month. So we get you some price action this morning. Let's do that this Tuesday morning, shaping up as follows. Stateside, equity futures lower, NASDAQ futures much lower. The NASDAQ right now, negative 250 and off by more than 2 percentage points. In the FX market, euro dollar 118, and in the crude market, there's the move, Tom, negative 5%. Yeah. I think it is decidedly risk off this Tuesday.
I'm really glad you brought that up. Brent crude maybe is going to print a 39 now, $40.62. And I would note the VIX, three big figures, up 33.97, make that up to 34, showing some of the tension. All of this, the economy, and of course, John's conversation with Mr. Kudlow folds into the state of the economy and what it means for politics when nobody really cares about the economy. Kevin Cirilli's expert at this, our chief Washington correspondent as well. Kevin, is it perceived by both campaigns that it's a recovering economy?
No, it's not. I mean, and that's such a really brilliant question, because the Biden campaign is saying that this economy is not headed in the right direction, that it's not recovering at the pace that they would like to see, and that it's not moving in the direction, and that the Republican conservative ideology has only benefited the elites. And so in contrast to that, the Republicans are saying that the economy is moving in the right direction. And you know, it really is an incredibly consequential crossroads that American voters are at right now, because should they choose to have a single party, whichever party, be in control of both chambers as well as the White House, that means that the recovery route that voters will choose to take is incredibly different depending upon the parties. And so that's why it's been fascinating to watch the recalibration of sorts in the Senate down ballot races, Tom, because a lot of these swing states are now trending back towards a divided government, which would indicate that the Republicans might control the Senate.
How do they adapt with 55 days to go to 10 to 13% undecided, as Mr. Vallier mentions this morning?
Yeah, well, Greg nails this, because it really is coming down to, you know, the Lordstown vote in Ohio or the inland vote in Florida. And so we've talked in the past week about Kenosha County. And so this is really the precise moment. And I think what you're going to see from the left is that vice presidential nominee Kamala Harris is going to be trying to go out and rally the base. Over the weekend, she met with the family and legal team for Jacob Blake, while nominee Biden is going to be much more trying to target those same specific voters that Greg highlights in his note. In contrast to that, I think you're also going to see a similar strategy on behalf of Republicans. The Vice President Pence is going to try to rally that evangelical base, but the president is going to try to go into those working class communities and get them back to reform that coalition.
Kevin, what a weekend as far as China's concerned. The Walt Disney Company writing a love letter to the Chinese Communist Party, and then the administration, the president coming out swinging. What was your take?
Well, look, I talked to sources over the weekend, Jonathan, who told me that the president is, in fact, considering banning cotton imports from the Xinjiang province in retaliation for the oppression of the Uyghur minority group in that particular region. Now, China, 80% of China's cotton exports come from that region, and 30% of U.S. Apparel comes from China. And so the supply chains really could have an interesting effect, particularly for some high-end fashion brands in the United States. Beyond that, this is part of a broader strategy that we've all talked about. And as far as Mulan goes, you know, I saw Tenet over the weekend, and I guess I'm more of a Christopher Nolan fan.
Well, no, but sticking with trade, how much is this hot air? How much is this just continuing with rhetoric, but not necessarily action? I'm looking at the August trade surplus with China. It rose to the highest since 2018 of $34.2 billion, the trade deficit that the U.S. has with China. This comes after all of the measures that the Trump administration has put in place. Are they going to have a tough talk, but do more of the same?
Well, I think, Lisa, the president yesterday using the word decoupling and just now openly talking about decoupling. And I think that the trend of the rhetoric, typically, as we talk about in coverage of this administration, typically the rhetoric is very fiery, and then the policy lags on behind. And so I think that it's a much more measured policy implementation, but there's no other way to look at this, whether it's the Pentagon report that came out over the past or last week with regards to the military capability of China, or it's looking at how things like the imports. But I would also note, I mean, we've also come a long way from the president promising Foxconn facilities in Wisconsin that are no longer following through.
John, does the president, excuse me, Kevin, it's Tuesday, Kevin. I'm not thinking. I was so emotionally taken by the end of Mulan that I'm not thinking clearly.
There's only one Jonathan Farrow.
Yeah, it's true.
Thanks, Kevin.
Kevin, does the president have $100 million to put into the campaign?
I mean, I guess. I mean, I think for, he's a billionaire, so I guess he does. But I think it's just a sign of the times of how expensive. Which, to put it in perspective, no matter what party you're in, think of the cash that Democrats and Republicans are spending on this cycle in comparison to the fiscal stimulus that has still eluded this town.
Kevin Cirilli, always great to catch up with you, sir.
Thank you.
Bloomberg Chief Washington correspondent on the latest out of Washington. Tom, let's talk about that economic recovery. If you bring up the ECSU screen on the Bloomberg, just gives you a quick snapshot of upside, downside surprises across various segments of the economy, in this case, the U.S. economy. Tom, every single segment of the U.S. economy still surprising to the upside. So that's the data doing better than expected. And I've got to say the recovery is doing better than expected. Coming into September, I think a lot of people were too bearish on the U.S. economy and the recovery into the back end of this year.
But I would frame it as people are delaying their cause for concern. And what's critical, John, is I don't know if they're delaying to October or they're delaying, say, to the first week of December. I just don't know. You're right. It's been much better than expected, but there's just this belief about Q4.
Yeah.
And, of course, we're not there yet. It's a mystery.
We're not out of the woods. No one thinks we're out of the woods, though. When you consider the fiscal package and the conversation we've had with the administration in the last couple of days, Tom, I think they're comfortable with the trajectory of the recovery. A month ago, there was some real urgency to those talks. There's not anymore.
I agree.
And I wonder whether that $1 trillion effort from the Republicans actually comes in a little bit, and the Democrats have to come in even further. Just as far as those negotiations are concerned, Tom, I think the Republicans have a little bit more leverage, relatively speaking, to what they had 30 days ago.
But do we see it this week? And that's the point to me. I mean, time's running out. And do we see it this week? I see no indication we do.
Coming up on this conversation, Sebastian Rajappa, Societe Generale's head of U.S. rate strategy. Looking forward to that chat in just a moment as we count you down to the opening bell a couple of hours away. Right here on Bloomberg Surveillance, equity futures down 25, down 0.75% on the S&P 500. On the NASDAQ futures, another leg lower in the last 10 minutes. We are down by 2.4%. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
From New York and London, this is Bloomberg Surveillance Live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Choppy price action to kick off things stateside this week. A shortened trading week stateside in Europe. The euro, 118.03. The story, though, is in the equity market in the United States. Equity futures down, NASDAQ futures down 2.41%. And let's just pick out a single stock, Tom Keene. Switch up the board and get straight to Tesla. Tesla down in a pre-market by 12%. Down and down hard, not included in the S&P 500 in the announcement put out on Friday. But, Tom, I've got to say, what are we up this year? 400%? I think about 400% year-to-date 2020 for that stock alone.
And only pulling back about 27% from the peaks we saw, the daily peaks that we saw a number, I'm going to say a week and a half ago as well. I would also note, and this goes to the demand equation, U.S. crude 37.66. That's stunning 5% move. And Brent crude holding at 40.63. Gold south fractionally as well. And it all points to yields coming in. They sort of kind of like have. Subhadra Japa joins us with SocGen, and of course what's wonderful here about her skill in U.S. rates is the heritage of SocGen in the derivative space as well. Over the weekend, Subhadra, you had to combine in the derivative analysis of the SoftBank Gamma trade with what the fixed income market will do. Is there any correlation there? Is there a linkage between your world and the equity derivative Gamma world that we're seeing right now?
There actually seems to be a very little correlation between the two markets, at least in the last couple of months, because bonds have stayed very much range bound, and I think that supported the equity rally, if anything. So there seems to be a huge divergence between the signaling you're getting from these two markets.
Is the signaling of bonds aggregate demands diminishing? I mean, can you link it up with lower oil prices and link it up with global slowdown expected?
Absolutely. I think that the bond market's extraordinarily cautious, which is what you would expect. And I think lower yields are fueling the rally in equities. Broadly speaking, I think the data, in July and August has been sort of plateauing. You saw this sort of sharp move higher in the data in May and June. So, the market's extraordinarily cautious given the rise in the infection rates. And the fact that we haven't gotten enough fiscal stimulus is also keeping the market somewhat range-bound.
Subhadra, for a while now, people have talked about the potential for the Treasury market to turn into a zombie market because of the Federal Reserve's huge moves over the last year or so, and not just the Treasury market, the credit market as well. Subhadra, from your perspective, is the long end aligned with fundamentals and the trajectory of this recovery?
No, because of the fact that the market's pricing in a lower for longer paradigm, given the fact that the Fed is going to keep interest rates low. And there's still a lot of uncertainty about the trajectory of future monetary policy initiatives. Will they purchase more? Will they purchase more weighted towards the long end? So the long end of the curve reflecting the tug of war, I would say, between this glut of supply we're going to see in the second half versus the potential for the Fed to start purchasing more in the long end. So you're seeing a very range-bound market across the curve. But I think ultimately the supply picture is going to outweigh any sort of demand you're going to see, or I should say, marginal buying you're going to see from the Fed.
Well, let's talk about the supply picture, Subhadra. Your basic assumptions right now going forward and how they would need to adjust, if at all, if we don't get a fiscal deal, another deal down in D.C.
I think that in the August refunding, the Treasury already accommodated for, I would say, about $1 trillion in spending coming after the August refunding meeting. So the supply has gone up quite meaningfully in anticipation of another deal getting passed through, and that hasn't really happened. So, regardless, I think that the supply and deficits are going to be higher for the foreseeable future. So I think that that's going to be something that weighs on the long end over time, especially if the fundamentals improve and yields start to rise, reflecting better fundamentals, then you should see steeper curves.
When you talk about the marginal buying by the Federal Reserve, so far it has been that. And for the past 2 months, the Fed's balance sheet has stayed pretty much consistent, constant. At what point, if yields do rise, do you expect the Fed to step in more meaningfully?
I think if the move in yields is somewhat erratic, you see some sharp rise in yields like we saw, after the taper tantrum, or if there's some sort of a fundamental reason for lack of liquidity, I think that's when the Fed steps in. If it's a very gradual rise in yields, warranted from improving fundamentals, I think the Fed will be okay. So any sort of sharp move higher in yields is when I think I see the Fed coming in and sort of putting a lid on how high yields can go.
So one of the big raging debates right now, people get really heated about this, is whether the 60-40 portfolio is dead, whether treasuries basically at yields this low are an insufficient hedge against volatility. Do you agree with that thesis?
I think so, because if looking back even the last couple of decades, I mean the 60-40 portfolio has been bonds rallying and stocks rallying, right? So the fixed income portfolio has never been a strong hedge for equities, maybe over short periods of time, but not over a longer horizon. Now you're seeing even less of that, given the fact that the Fed is going to we have an environment where negative interest rates are not in the cards, which means that interest rates are floored at zero. So there's only one way treasury yields can go, either sideways from here on or higher. And I think that dynamic doesn't play into the 40-60 portfolio paradigm.
I look, Subhadra, at this, and folks, we've got NASDAQ breaking down now 2.7%, 308 points. We're at a new weakness today as well. The vol that we see in the equity markets, are we going to see that in the bond markets?
Probably not. I think if 10-year treasury yields, for instance, have been between 50 to 80 basis points. That's probably where they're going to spend the remainder of this year. So I think that there's really this lower for longer paradigm. Generally, the Japanification, I would say, of U.S. bond yields is going to keep volatility somewhat low. What you're seeing now is market positioning, for a potential rise in yields and enriching of perhaps some of those metrics like pair skews. But broadly speaking, I think vols are going to remain low for the foreseeable future.
Why is that? Why? How does it dampen down? Is it just Fed intrusion into the market where it's not a real market? I mean, I just don't buy the idea that you should go quiet.
Yeah, exactly. I think that the participation of the Fed is not something that's near term. This is an open-ended purchase program where they're purchasing $80 billion per month, and that size could potentially increase if there's volatility in the markets, not decrease. So given that sort of paradigm, it's really hard to envision, especially the yields from 2 years to 10 years, being very volatile, given the fact that they're at historical lows, and they're going to be low given the fact that the Fed is committed to a lower for longer strategy.
Subhadra Rajappa of Societe Generale, it is the day after Labor Day in the United States. Normally this is a time when people would be getting back to work, back to the office. People are just getting back to their computers where they've been at their kitchen tables all this time. Can you talk about the change, whether we're going to see any shift in positioning, any shift in strategy at this point as people reassess in their post-summer meetings? Or do you think that this year is just going to be different because you're just going to get that consistent feeling of in limbo?
I think it's going to, unfortunately, be a consistent feeling of needing more data before you can have a clear direction on treasury yields. Broadly speaking, this week we get a lot of supplies, so we could see some concession into the auctions. But other than that, the dynamics are going to be led by the infection rates and not having clarity on the data. There's a lot of volatility. You're going to see upward revisions to data as well as downward revisions to data. I think that's ultimately
a problem with the connection there with Subhadra Rajappa of Societe Generale. Subhadra, I'm just going to jump in and wrap up the conversation. Thanks for joining us. Unfortunately, that did happen right at the end of the interview, but maybe that's fortunate too. Let's get to this market right now. Equity futures right now grinding lower. Another breakdown on NASDAQ futures. A bit into the bond market, down 5 basis points on 30s. On a 30-year, your yield now just north of 140. And a headline crossing a Bloomberg. Lisa Abramovitz, let's get to that just briefly. Coming out of GM.
Yeah, GM coming out saying that they are going to get a $2 billion equity stake in Nikola, which is sort of interesting at a time when you see this move with car companies and tech companies. At what point are you just driving a computer, John? And that really is a question moving forward. How can some of these automakers get enough scale, get enough of a broad base appeal so that they can sustain whatever comes next?
Well, Lisa, speaking of car companies / tech companies, Tesla taking another leg lower as well, down by around about 12% in the pre-market, still up on the year massively, but it's the price action of the last week that I think has got everyone's attention, Tom. Equity futures lower, the NASDAQ down by around about 300 points right now, negative 2.6%.
There's a deterioration, John, and what's important here, there's been fits and starts of a bid this morning, but I'm going to state, John, looking at the Bloomberg, it just has not happened. There's a nice chart intraday. For those of you on Bloomberg Radio, it's real simple. Yeah, once, twice, 3 times, a little bit of a leg up. But, John, the bid isn't there as we go negative 305 on those NASDAQ futures. They're getting correlated back to Apple and Tesla, but critically, John, correlated back to a lot of other stocks as well.
Taking out some of the froth, Lisa Abramovitz. That's what we've been doing and building up the froth through the month of August. We've touched on this subject a number of times now in the last week, looking for justifications for the unjustifiable. That was the mission for so many people over the last month, but some of the moves just weren't justifiable, and we're starting to see some of that froth come back out.
The problem I have, John, is we're not hearing anything about what the fundamental valuation, the fair valuation of the Amazons or the Apples really is, because nobody knows, right? So we're dealing with a situation where people are still trying to justify technicals, and we don't have a sense of where the actual valuation should be at a time when interest rates are this low.
Yeah, okay, but John, does it say entry point?
You're the one
for me, Tom, or for you?
For me, I mean, I've been waiting, but I think I better stay on the sidelines.
I think we've got a different risk tolerance, haven't we, Tom? That's why I asked the question, for me or for you. I think for you, you need a much bigger gap lower than the one we've got over the last couple of days. Equity futures down, a bit into the bond market, dollar strength. It's all set up for some risk aversion this Tuesday morning with equity futures down 2.7% on the NASDAQ. When Tom starts rotating from cash into the equity market, I don't know what kind of signal that's going to be for you.
He's singing.
From New York and London, Tom, your broker does not know who you are anymore. This is Bloomberg.
I'll buy 10 shares. Yeah, bye.
With the First Word News, I'm Kaylee Lines. Bloomberg has learned that Donald Trump is considering an unprecedented step for an incumbent president. He's discussed spending as much as $100 million of his own money to win the election. The president has been scrutinizing heavy spending by this team earlier this year that failed to push him ahead of Biden. Plus, Biden's campaign and other Democratic entities have outraised the Trump campaign in recent months. Meanwhile, President Trump is threatening to curb the U.S. economic relationship with China, and he's promising to punish American companies that do business there. The president's calling on those firms to be banned from getting federal contracts. He also wants to impose tariffs on companies that leave the U.S. to create jobs in China and elsewhere. President Trump said that if Joe Biden is elected, China would, quote, own the U.S. In California, the electricity crisis has gotten worse. The state's biggest utility says it expects to cut power to 500,000 people this week to prevent live wires from sparking wildfires. Last week, that problem was a heat wave. This week, California is expecting high winds to come sweeping off the Pacific Ocean. Kamala Harris made her first solo campaign trip as the Democratic vice presidential candidate. She went to Milwaukee, where she appealed to communities of color that will be crucial to winning the battleground state of Wisconsin. Harris met with black business owners. She also talked with Latino activists who advocate for frontline workers. Morgan Stanley is bullish on U.S. airline stocks. The firm initiated coverage on the sector with overweight weightings for Southwest, JetBlue, and Delta. Morgan Stanley says the recovery from the pandemic will be bumpy, but it predicts passengers will return once a vaccine is found. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Limes. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revisions.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
Younger generations are the ones who are most scarred. It happened in the global financial crisis. I'm concerned it's going to happen here as well.
Catherine Mann, Citi Global Chief Economist, on the fallout from the COVID crisis. Let's get to the market action this morning. This Tuesday morning shaping up as follows. Stateside equity futures down hard. NASDAQ futures off by 2.84%. In the FX market, a bid to the dollar broad-based through much of G10. Euro dollar south of 118, 117.89 going into the ECB decision this coming Thursday. And there's the bid in the bond market, down 4 basis points on a 10-year to 0.68%. Chief of Staff for the White House, Tom Keene, Mark Meadows speaking right now. He's optimistic on a stimulus deal before the election. That's the way people feel about this. Well, why it's when, not if, because there's an election coming up, and many people believe that's the incentive to make it happen.
Driving that story forward, and Kevin Cerulli and David Weston will follow that this morning. We welcome all of you on our simulcast, and we are going to stay on the markets here. Really some significant deterioration with the VIX out almost 5 points, 35.42. Right now, though, we need to reset. The reset for John Farrell, Lisa Abramowitz, and me was somewhere in the vicinity of the third week of February, culminating in March, where things deteriorated and were horrific in New York City. The miracle of the United Kingdom improvement in deaths, the miracle of what New York has done in deaths, and a few other states as well, has been noted by all within the medical community. Robert Murphy is expert on this at Northwestern, professor of infectious diseases, and we're thrilled he could join us here the day after Labor Day. It is a reset, sir, as this pandemic ages. What is to come?
Again, I lost the last half of the sentence there.
Well, we're going to see, coming off of September here now into the colder weather, into October, into December, and into next year. What do you presume we will observe?
Oh, what's going to happen is there's going to be an uptick as people end up in buildings closer together, just here.
Well, Robert, it seems like we're losing your connection. We're speaking with Dr. Robert Murphy of Northwestern University. Let's try to reestablish it, and when it's better, we'll come back to you. But really, Tom, I mean, to me, this is the question. How bad is it going to get as we head to fall, as people are closer together, as the air gets drier, and as people get sick of it? They want to see their friends. They want to be together, and we saw that over the weekend.
The fatigue is there. There's no question. You see it in Albert Camus' The Plague as well, 1946. But, Lisa, to me, what is so important here is this debate about getting out there and doing. Claudia saw moments ago, The Economist in Washington, just a simple Twitter photograph of a street the day after Labor Day, and it looks like a Sunday in 1950.
Yeah,
it's empty.
It's empty, and the question is, how quickly are we going to get a vaccine? And then once we get the vaccine, are people going to believe that it is safe enough to be injected? And then once that happens, how long does it take to get some sort of herd immunity? This is the difficulty. And John, to your point, with Mark Meadows coming out and saying that he's very optimistic about a vaccine by the end of October, you have vaccine makers coming out and working together to basically say, you know what, we are not going to put anything out there unless we are sure of its safety in order to dispel this fear of the vaccine.
Elisa, let me tell you, there is so much fatigue out there right now. The anxiety that people had around the economy, the mental health issues that this pandemic has created that, let's be honest, we haven't talked about enough, not just on programs like this, but around the world. And Tom, I have to say, look at what's happening in New York City right now. The statistics are good. They're great. Fantastic. What about small businesses at the moment? What about the restaurants? Mayor Bill de Blasio has said in the last week that we might not have in-restaurant dining until we have a vaccine, potentially 2021. Tom, can you imagine the devastation that is still to take place in this economy if that's the case, if we can't live with this until 2021?
And I'm going to be blunt to all of you on radio and TV. I'm going to be a pinata on this out on Twitter and emails. John, you and I and Lisa try to keep our opinions out of this. But it is absolutely bizarre to look at the math of cases and particularly deaths and the emptiness of these restaurants, the emptiness of small business.
But that's the reason why.
Tom, let's build on that.
Yeah,
Melbourne, Australia has shut down. Victoria has shut down, Tom, and the lockdown's going to continue off a very small number of cases and deaths relative to what we've seen take place elsewhere. Tom, it's a very crude and ugly story, but it will come down to tolerance. And I just don't think the tolerance is there this time around, the willingness to have another shutdown as we go into the winter. And I want to understand what the metrics are as we pare things back. In the UK, for instance, cases have picked up again. And as I understand from domestic reporting this morning in London, Tom, there's a real conversation about maybe reducing gatherings. But as for locking things down again, nobody wants to go there.
Lisa, one more observation on this, and we've got to get back to the markets. SPX down 40 points. Lisa, the school issue is absolutely front and center. And to me, the single thing not discussed in the media is people with child care. To me, that is every state, every city, that is the #1 metric right now.
You're not going to be getting people back to the office or back to work in the same kind of capacity that they have been in the past without that exhaustion factor until you have child care. Again, though, this is the big question, and I'm I'm glad that we're talking about the virus with the backdrop of the markets, because right now we're seeing the markets deteriorate with a lack of any sense of how quickly the economy is recovering. It's recovering better than expected, Tom. But then you also have this question of how long will this last? We don't know. People saying the vaccine is going to come soon. We don't know how quickly it'll be before life gets back to normal after that, if it happens.
On our simulcast radio and television, the market. John, I'm going to look at oil very quickly, tangential to the NASDAQ debate right now, but West Texas just pounded. We had a 36 print moments ago, 37.16. That's a solid 6.6% move, John. That is a plunge in oil.
Yeah, things are breaking down in the equity market too. We've talked about it a lot over the last week. It's happening again this morning in the NASDAQ. NASDAQ futures down around about 325, negative 2.82%, a bit into the bond market. Tom, it's classic risk aversion. I actually asked Larry Kudlow the question directly. Will this market rout shape your effort on the fiscal side? He seemed very comfortable with what was happening in equity markets.
Do you think the president agreed
There
with
is
him?
a real belief. We'll find out. I haven't heard the president comment on it just yet, but there's a real belief for them that this economic recovery continues. And in the data right now, you can see it. Andy Haldane of the Bank of England came out with some really controversial comments in City AM this morning, Tom. There's a furlough program in the United Kingdom which basically allows people to continue to get paid to a certain amount of their previous wage, and the government is contributing to that big effort. It's the reason unemployment is still so low in the UK. That effort expires in a month, and the chief economist of the Bank of England is basically saying let it rip, because all you're doing is delaying the inevitable. Now, I don't necessarily share that view, and if Andy Haldane shares that view, then please, him first, take a jump, you retrain, go retrain to do something else. Well, until we reopen this economy properly, Tom, you can't judge what jobs will be gone permanently and which jobs will come back. John, right now, we haven't reopened.
John, this is absolutely critical. And Ambrose Evans Pritchard writing this up in the Telegraph earlier this morning. The comfort of politicians, John, to affect austerity, I'm fascinated by with where this global economy is right now.
Bond market's still wide open. Gilt market's wide open. Treasury market is wide open. I'm not saying it will always be wide open, but this is a political decision. It's not an economic one. Right now in the markets, things are still wide open for these governments to be funded. Coming up on this program on the equity market, Chris Marangi, Gabelli Funds Co-Chief Investment Officer, coming up next right here on Bloomberg Surveillance.
things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from Customer Support is responding to a 500% increase in daily call volume. No matter what, we keep on, so you can keep on.
The longer term is not looking good right now in terms of the support for consumption.
This economy is dynamic, but not dynamic enough.
Doing too little is clearly the problem. It's hard to see what the consequences are of doing too much.
I think we're all focused on that September Fed meeting.
We are seeing an income crisis. We are seeing inaction from Washington, D.C., and we can't afford to do this again.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television worldwide across this nation. The beginning of the new year for business. After the summer, the Tuesday after Labor Day marks a new beginning for Wall Street. And John Farrow and Lisa Abramowitz, what a beginning we mark today with new volatility. John touching new lows moments ago on NASDAQ futures.
NASDAQ futures down and down hard, Tom, off by more than 2.8% now, down 333 points. We're still up on the year big time, up on the year by more than 30%. And some of these companies, Tom, are performing really well for a good reason. They've been fantastic through 2020 and way back as well. There are really strong transformational forces that have been accelerated by this pandemic. The stories are really good. It's about the price of the story, Tom. What price are you willing to pay with rates at zero for a long, long time?
What an odd market to see the rates at zero, future a 10-year yield rather in 3 basis points, 0.69%, 30-year bond 1.43% as well. Yields lower, oil substantially lower. It's been off our radar for weeks. $37 on West Texas. Brent trying to hold it at $40.42. And Lisa, the correlations here are tangible this morning, and yet, as you mentioned to John earlier, tons of supply coming on. That's all that new fiscal debt. We're going to see it in moments, right?
We're going to get $50 billion of 3-year treasuries.
What's the so what on
today. That? The so what is that's a record amount. The so what is that this leads off of a heavy supply of treasury sales this week, and it leads off on another week of uncertainty when it comes to stimulus. We don't know how big the stimulus package will be, so we don't know how much debt the U.S. Treasury Department will have to ultimately sell at a time of uncertainty about inflation, as well as how quickly the economy is going to get better. Tom, just so much uncertainty, and yet Apple shares, the bastion of certainty, down 4.6% ahead of the market open.
Well done, $2 trillion, and then we go on to that. John, one more question before we get to our esteemed guest, and of course that's the real yield. Look for the real yield, folks, with John Farrow. Yes. It shows up somewhere at the end of the week, 3-4 hours. So it's about as long as
for you this week.
It's about as long as
a tease, Tom.
Yeah, it's about as long as Milan, actually. When I think about it, the real yield, John, has fallen off the radar. If we get global slowdown, that real yield becomes important.
Yeah, well, there hasn't been a real yield, and that's been the story over the last year, hasn't it, Tom? It's underpinned some of those valuations, too. Lisa mentioned the supply. Look at the front end of the yield curve. Your 3-year note right now, the yield, 16 basis points. The front end of the yield curve is still absolutely anchored by the Federal Reserve, and there is no sign that the supply is disrupting this Treasury market, at least at the front end. could develop an argument about the longer end in the not-too-distant future, Tom, but at the moment, it's a Treasury market wide open for more supply.
Some real soup out there this morning, folks. We're thrilled again you're with us on radio and television. Chris Marangi with us with Gabelli Funds, our co-chief investment officer. Chris, I want to start with sort of not the equity hysteria that's out there, but the media angst that's going on right now. How do you define a correction in 2020? Is it down 10%, or is there a new calculus for Gabelli Funds?
This is nothing. Listen, this is healthy. Obviously, the correction is concentrated in a few stocks. Those few stocks happen to have accounted for more than 100% of the gains of the S&P so far this year. So, you know, this is a different correction than certainly we've seen in the past.
Here's a money question for the day, Chris. And when I saw our lineup earlier this morning, when I walked in hours before John Farrow and Lisa Abramowitz, I would want to point out, Chris, that I really went to the heart of the matter, which is how should our listeners and viewers who are not sophisticates in derivatives, how should they adapt to the NASDAQ well, the gamma well? Do they just ignore it?
So I am certainly not an expert on market internals and why the market is short gamma, but it certainly has introduced volatility. It's powered the move up in part, along with a lot of other factors, and it appears to be driving the reduction that we're seeing in futures. So something to understand, be aware of, but at the end of the day, we're looking at the fundamentals of each of these stocks. And as Jonathan pointed out earlier, the fundamentals of those big five stocks have been terrific so far this year.
Chris is just trying to work out the appropriate multiple to pay on some of these companies. Can you just give us some insight into those conversations right now over at Gabelli?
Yeah, that's right. So, you know, in general, obviously, where rates are pinned and appear to be pinned for a very long time, you should be willing to pay a higher multiple for any stream of cash flows. And the question is, you know, how durable are the cash flows of, say, those big five, if that's what we're talking about, and what should you be willing to pay for them? You know, it seems that a year ago, obviously, they would have been at bargain prices. But at this point, the market is making a bet that the durability of that cash will last a very long time, and that they grow, you know, at probably double global GDP growth for the next 10, 15, 20 years. That's a little bit of a harder bet to make.
So are you holding, are you buying, or are you selling into this great dip of 2020, as Tom might name it?
Yeah. Well, we've been buying different kind of stocks. We've been buying the smaller and unloved, what would be considered value stocks. Some of those stocks are still off over 30% this year. In fact, a quarter of the Russell 3000 is still off by 25 or 30%. And that's where we're seeing bargains. You know, amongst the big five, you know, we've owned Google. It's a media, essentially a media name that we can understand. We've owned a little bit of Facebook over time. Haven't owned Amazon. Unlike our patriarch Warren Buffett, haven't been big in Apple, at least on the value side. I think there are some idiosyncratic issues there that we're very careful of, particularly around China. So, you know, this hasn't really changed our view on valuation just yet.
Although at a certain point, it does become concerning from a faith perspective, the idea of what does this do to the marginal investor who has an allocation still in safer assets, who was going to go into stocks, that suddenly sees these high flyers, these staples of certainty being absolutely pummeled, even if it is short term and even if year to date the gains are tremendous. At what point do these become systemic issues? Do they become systemic sell-offs that really infect the other parts of the stock market?
Well, you know, it's a great question. You know, coming into last week, those big five were almost a quarter of the S&P 500. Lots been written about that. It's sort of an unprecedented level of concentration. So if you thought by buying an S&P index fund you were getting a nice diversified set of equities, you may need to rethink that. You know, those five companies not only are a large part of the S&P, but they're all essentially driven by the same kind of dynamics. They're all, even though they're different industry classifications, all essentially internet platform companies, subject to a lot of the same risks. And that's really unprecedented, and I think leaves the average investor exposed to maybe more risks than they were thinking they were taking.
Going on right down to NASDAQ, testing new lows on 340 points, 3% move here. John Farrow, I give you great credit for this because I keep talking tech, and through the year, JP Morgan down 24% from the February highs. That shows the damage out there just in the banking area alone.
The banks have struggled through 2020. Jamie Dimon said months ago, and it got everybody's attention, that this isn't a normal recession and we haven't seen the impact of this recession just yet. It might come later this year. Chris, as you look at the financials, how do you think about that?
Yeah, again, these are obviously names that are very sensitive to the shape and absolute level of interest rates, and that's not been a good story for them. Net interest margins were starting to perk up at the end of last year, and now have compressed again, and we don't see them expanding anytime soon. That being said, they're priced for that kind of outlook. The other dynamic, obviously, is a lot of fear that especially came in March about credit. Credit seems like it's probably going to end up a little bit better than was feared, but still, is going to be an ongoing issue for some time as we work through this recovery.
Chris Maranghi, new lows here this morning, negative 3.1%, down 350 NASDAQ points. We break down to new lows right now. When for you guys does tech become cheap?
I don't know if I can answer that at a macro level, but we're obviously looking at all sectors. I think there's a lot to like in tech. A lot of those business models, particularly amongst the big five, recurring revenue models, subscription, low capital intensity. These are all things that fundamental investors should love. Again, as you to your point, what do you pay for that? We generally are when we're looking at tech, we're looking at technology embedded within other sectors, because obviously things like everything from AI to automation, impacting the productivity of those other sectors. And that's generally where we're looking to play tech. We're also playing tech in some derivative manners. The value of broadband has been highlighted through this crisis. You can't get any of those tech services without a fast broadband connection. I couldn't be here doing this without a fast broadband connection. What am I willing to pay for that? I'm willing to pay a lot for it. And so that gives those companies a lot of pricing power, and that's why we like the erstwhile cable companies, now known as broadband infrastructure companies.
Hey, Chris, great to catch up, as always.
Wonderful.
Chris Maranghi there
Wonderful.
of Gabelli Funds. It started at about 4 a.m. Eastern time, and it has continued, and we have taken another leg lower, Tom Keene. We are down 3% on NASDAQ futures. If you want to get to single names, stock-specific, Apple in the pre-market, this is a $2 trillion company now, is down 5% and change, Tom, in early trading.
Okay. Keep that chart up, folks. On Bloomberg Radio, I'm going to describe it to you. Not every point, but every point on the intraday chart of the NASDAQ is a series of lower highs through a percentage of the morning. John, the percent tick by tick of lower highs is critical, and right now that is a vector south, no question about it.
A messy start to this morning, Tom, and an exhausting day ahead maybe. NASDAQ futures down 3%. I went to the gym this morning, Tom, 5 a.m. local.
I did not.
Very quiet. Very quiet. They're limiting the amount of people that can go in there. And then after 60 minutes, you have to vacate. They come in, they clean the whole place, and another batch of people come in. 60 minutes, they vacate, you clean the whole place. So on and so forth throughout the whole day. That's how gyms are operating in London now, Tom.
I did 60 minutes.
I just thought I'd let you know, just in case Mrs. Keene is pushing that agenda after 6 months of being locked down.
You mean the pandemic pounds? The pandemic.
Oh, she may or may not have informed me that she's trying to push you in that direction and asked me this morning to bring it up.
Just to
inspire you a little bit.
Like John Farrow.
Or to try. Just to try. Coming up on this program, Peter Westaway, Vanguard Chief European Economist. Is that how long it would take to get shredded, Tom? 6 minutes. This is Bloomberg.
Bloomberg has learned that President Trump has discussed spending as much as $100 million of his own fortune on his re-election campaign. It would be unprecedented for an incumbent president to put his own money towards winning a second term. The president scrutinized heavy spending by his team earlier this year. Plus, Joe Biden's campaign and other Democratic entities have been raising more money than the Trump campaign in recent months. Drug makers racing to produce coronavirus vaccines have come out with an unusual public letter. In it, they promise to avoid shortcuts on science as they face pressure to rush a shot to market. The CEOs of 9 drug makers signed the pledge, among them Moderna, Merck, Pfizer, and Sanofi. Meanwhile, President Trump is hinting that the U.S. could approve a coronavirus vaccine in October, just before the election. President Trump is also vowing to sharply scale back U.S. economic ties with China. The president threatened to forbid companies that do business in China from winning federal contracts. Plus, tariffs would be slapped on companies that leave the U.S. to create jobs in China and other countries. The president also said that if Joe Biden wins the election, China would, quote, own the U.S. Meanwhile, China is proposing global data rules to counter U.S. moves on TikTok. Beijing outlined a slate of proposals designed to prevent foreign governments from acquiring data stored locally. The U.S. has accused services like TikTok and WeChat of sharing information with the Chinese government. And shares of Tesla are falling today. The electric car maker was widely expected to be named to the S&P 500 on Friday, but it didn't happen. That may have been because of Tesla's profitability metrics and murky full-year forecast. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lines. This is Bloomberg. This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Our reliance on China once and for all, whether it's decoupling or putting in massive tariffs like I've been doing already, and will impose tariffs on companies that desert America to create jobs in China and other countries. If they can't do it here, then let them pay a big tax to build it someplace else.
That was not a campaign rally. It sounded like one, though. That was the President of the United States in the last 24 hours coming out, swinging. Here's the price action this Tuesday morning. Let's get you up to speed, shall we? Stateside equity futures lower, much lower. Over the last 4 hours, we just break down. On the S&P 500, down by more than 1% now. NASDAQ futures down by more than 3 percentage points, negative 3.33% and down 385. You see the risk aversion cross-asset into the commodity market, crude lower, down 6%, into the bond market, bid at the long end, curve flatter, down 4 basis points on a 10-year to 0.68%, and into the FX market, Tom, dollar strength, euro dollar, a break of 118 at 117.93.
I'm going to do more on the markets here, no question about it, with a real breakdown on NASDAQ in the last moments. Oil, 37.42 indicates all you need to know, negative 6% on West Texas Intermediate. Right now, on the complexities of China, we're really going to rip up the script here, and we can do that with our Chief Asia Economics Correspondent, Enda Curran, who can synthesize for us the domestic Chinese experiment with what we see internationally. And then it comes back to the election and Trump and Xi and Beijing and Washington as well. But even further complexed with the release of this movie by Disney. And I go back to last summer where the lead actress of Mulan somewhat came out in support of the protesters that we saw in Hong Kong. Explain the complexity that Hong Kong and the people of China face over this movie in this moment for China.
Well, I think it speaks to, Tom, the ongoing tensions between both Beijing and Hong Kong, like you mentioned, since Beijing started to enforce or assert its territorial sovereignty over Hong Kong over the past year or so by ramming through the very strict national security law and, of course, by the police response to the protests of last year. So I think what you have now is a very divided kind of populace here at the moment, very divided opinions towards Beijing. The local elections that were scheduled to be held for the local assembly were postponed, ostensibly due to the pandemic. But then when this movie comes along, then of course it just kind of adds more, kind of pours petrol on the flames between both camps in Hong Kong and just deepens the division between both. And I don't think there's any kind of a near-term circuit breaker in terms of any outreach or olive branches from Beijing to Hong Kong, or certainly even the other way around.
Well, Enda, let's build on that word, division. You used it several times there. Another division is the divide between the U.S. administration and the C-suite in America. The Walt Disney Company, not alone, many companies in the United States looking for closer ties with China. How does this administration, if it gets a second term, look to get the C-suite in America to come along for the ride with them?
Well, it's interesting, John, one of the things that came out of President Trump's comments yesterday were some specifics around tax credits to bring American companies out of China and tariffs on companies that are doing business with China and the like. So that's kind of indicating that perhaps there is further to go on this decoupling. But as you know, it's a pretty complicated story because China doesn't just offer a pretty lucrative market, especially in the consumer goods area. It also offers scale for manufacturers, and scale that's still at a competitive price when it comes to manufacturing elsewhere in the world. And I think a lot of the chambers of commerce will say to you when they speak about this that it's not as easy, it's easier said than done to decouple the world's two biggest economies. I think it will be critical to see what kind of response we get over the coming weeks and months going into the U.S. election and how U.S. companies start to respond to this even more hawkish message from President Trump. But I will say on the Chinese side, they're showing a lot of confidence. Today we had a ceremony in Beijing with President Xi Jinping honoring party members and officials for fighting the coronavirus, and he said that the pandemic once again proves the superiority of the social system with Chinese characteristics. So China's pretty confident despite everything being thrown at it right now.
Well, and they're pretty confident, and perhaps rightly so, based on some of the recent numbers. I mean, the U.S. trade deficit with China reached the biggest since 2018 in August. This indicates to what John was talking about, this division between the C-suite in America and what's happening at the White House. How much have tariffs prevented that trade deficit from being deeper, and how much have they exacerbated it?
You're absolutely right, Lisa. I mean, those trade stats really do speak for themselves. Both the value of shipments to the U.S. and the bilateral trade surplus in merchandise goods were at the highest level since November 2018 in the month of August alone. And, China's export machine has been going gangbusters over the last few months since they opened up because they've been able to take advantage of U.S. demand for medical equipment. And it's not just medical equipment, but it's also electronics goods. And a few weeks ago, we spoke to toy makers, for example, and they were saying their order books were jammed heading into the annual holiday shopping season in the U.S. So the China export story is very much benefiting from the back of U.S. demand. The tariffs, of course, had an impact around its confidence, and of course had an impact in terms of marginal costs for some of these operators. But, the trade war on the merchandise goods story really has become something of a sideshow to what we're seeing more recently now, which is the moves on tech and the moves on national security, and of course the broader tensions over the pandemic. So I think it looks like China is continuing to do well on the U.S. merchandise goods story, even though tensions in the other areas are getting much worse.
Enda, great to catch up. Stay well, won't you? Enda Curran there, Bloomberg Chief Asia Economics Correspondent. The story between the United States and China. Here's the story in the markets right now. Equity futures taking another leg lower in the last 60 minutes. NASDAQ futures at the moment negative more than 3%. Let's pick on a single name. Apple, a $2 trillion+ company. This stock right now down 5.5% in early trading. Tom, the weighting of Apple on the NASDAQ 100 is about 14% of the benchmark of the index. It's roughly half of that on the S&P 500. It's a monster weighting in these indices. And let's be clear here, this is about single names. The option story, it is about single names, and that's been the story, the pain in these single names with massive weightings in the NASDAQ 100, in the tech sector and elsewhere. That's been the pain of the last week or so.
Yeah, John, within the physics of this is the word drift, which is a really cosmic idea in quantitative finance. And the drift of Apple, and to an extent Tesla this morning, again, is a series of lower highs, and it's extremely well contained. I can get the famous surveillance cursor out and tell you that since 4:20 a.m., John, it's been incredibly well contained, showing that unwind.
So, Lisa, how would you describe what we're seeing play out in the last couple of days? The realization that this might have just been one big whale, pushing options up, pushing bullish calls on single names to such an extent that everyone had to come along for the ride. The market makers had to buy the underlying. Is it just that, or is it more than that?
I find it really confusing. John, I'm going to be really honest. The market action today is confusing to me. On Friday, we saw a sell-off in treasuries, which people were talking about, the death of the 60-40 portfolio. Today, you're seeing correlation. Gold continues to drift lower as we see stocks sell off. How much can we say that gold has ended its run as a safe haven away from volatility in stocks, John?
NASDAQ futures negative 3.3%. The coverage continues. 1 hour and 5 minutes away from the opening bell. Alongside Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
Me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos. Y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas. vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración. Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esta enfermedad yo perdí todo, perdí mi trabajo. Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The long weekend is over. Summer's over in the United States and worldwide. In the Northern Hemisphere, that is, of course. I should suggest and be specific about that. I know that some of you out there might tweet me. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferrer. Let's get to the price action of the moment, shall we? Equity futures are grinding lower. A breakdown in the last 4 hours. We are down by 3 percentage points and change on NASDAQ futures. Euro dollar 117.99, coming in a 1/10%. It is a stronger dollar story. A bit into the bond market, yields lower by 4-5 basis points. The crude market lower by 5 percentage points. There has been a whale in the options market. Reportedly, it is SoftBank. And Tom, as you know, the decomposition process with whales, the buildup of gas, sometimes they blow up. And I wonder what's happening right now.
I recommend everyone read Fooled by Randomness, a short read by Nassim Taleb. It is absolutely brilliant when volatility hits Wall Street. And right now it's Fooled by SoftBank. Right now, the conversation of the day for those of you worried about fiscal dynamics. John Farrell's going to dive into the German view. I'm going to look more at the global view, and we can do that with Peter Westaway of Vanguard, their chief economist with prodigious math abilities out of York and Cambridge and operational research. Peter, the dynamics of this debate is wrapped around culture, which is austerity is good. Have we slipped away from the belief of the last number of years that austerity is a good and beautiful thing in a slowdown?
I think we have definitely slipped away from that. I mean, I'm not really convinced that was ever the economics mainstream, but it was certainly the policy mainstream. In Germany, that was very much the view, and that's why we've seen relatively tight fiscal policy there. But I think here in the United Kingdom, the appetite for austerity to get the debt levels down is something that we're not going to see for a while yet. I think the mood of the new government in the UK and perhaps more broadly in Europe is for much looser policy, perhaps just living with higher levels of debt. Let's not forget that the interest rates at which much of this debt is being funded during this pandemic is incredibly low, and so the burden that it's going to put on countries isn't going to be as great as it might have been in the past.
John,
at some point, it's going to have to be paid off.
Yeah, John Farrell, we hear.
Really what.
Well, I don't mean to interrupt, but John, I think this is really the heart of the matter: is a low-yield environment's a free pass.
So far at least. And when you use that language, Peter, that at some point this will have to be paid off, what does that some point look like?
Well, I think at the moment it's the last thing on the minds of governments because they're still up to their ears in coping with the pandemic. I think when and if we do get to this point when economies start to recover much more quickly, when the tightening cycle begins again. And again, we're a long way from that yet. At that point, I think the conversations will start to be about, well, what are we going to do about fiscal policy? Are we going to tighten policy? It may be, though, as I say, that we'll just learn to live with this, and perhaps, this idea that some of the debt will just effectively be monetized. Let's not forget, many of the central banks are sitting on this debt. At the moment, it's not really putting a burden on the government, because the debt interest is being paid by the Bank of England, effectively. So at some point, QE has to get unwound. That's what makes it QE. QE means that the debt eventually gets sold back into the private sector. When it's not sold back, that's when it's called monetary financing. And if you think of the history of QE, Japan, Europe, even the US to an extent, a lot of this QE is still sitting on banks' balance sheets. So we haven't really seen the cycle of QE play out yet. And so we don't really know how it's going to play.
Well, that's QE forever, isn't it, Peter? You just keep reinvesting,
exactly.
Maturing assets. You keep doing, you never forgive it, so technically it's not financing. There is another issue here, and it's not just the crisis response, Peter. It is the permanent change. That's what I'm interested in. I think we can all get our hands around what the crisis response looks like. We can see it in the last couple of months. Permanent shifts in the framework at the Fed, permanent fiscal changes in places like Germany. Can you speak to that for us, Peter?
Sure. Let me start with, as a former central banker, let's talk about what the Fed have introduced, this idea of average inflation targeting or price level targeting. At the moment, it's still not completely clear what they're going to do. I think the key message is that is going to facilitate easier monetary policy for longer. Personally, I'm a bit of a price level targeting skeptic. I think it's a difficult thing to carry off, to start worrying about inflation bygones, but that's really where we're going with that. Sorry. So, as far as fiscal policy is concerned, I think we are in a new regime, because I think the idea of getting debt down quickly, the way we did after the financial crisis, just isn't palatable. I don't think it worked very well for countries like Europe. I just don't think the political appetite for that is there anymore. There's just too many other political problems around the distribution of income and so on that makes fiscal policy and fiscal austerity just not a palatable policy option.
Meanwhile, they've got a partner in the central banks. We do have that ECB meeting on Thursday. Meanwhile, the Bank of England, which you were a member of, has considered or talked openly about negative interest rates. Do you expect that to be a tool used by them in the not-so-distant future, especially given the fact that there really isn't an easy pathway to paying back some of the debt?
Yeah, they've left it all open to negative interest rates. But even back at my time at the bank, over 10 years ago now, the idea of negative interest rates wasn't looked on very kindly. So I think they've probably got more work to do on QE before they go down that path. But I think they could do it. But I think we're getting close to the end of the road for negative rates for the ECB. I don't think rates can go that much lower.
Wait. Hold on one second. Peter, hold on one second. And I'm sorry to interrupt, but that's a huge issue. If you're saying that they're getting close to the end of the road with negative interest rates, do you think that they are going to, at some point in our lifetimes, move to a positive interest rate regime?
No, I don't mean they're going to reverse it, but they're going to keep the rates at the very low negative levels that they're at. And I think they will carry on putting QE into the system to push down yields, to ease monetary conditions. I think the big policy constraint question for the ECB is, at what point do they run out of government bonds to buy, and will they have to start breaking their own rules around which bonds they're able to buy? That for me is the big question, rather than whether they're going to go a lot more deeply into negative territory. So I think at the end of the day, especially for an economy like Europe's that's so dependent on the banking system, you do start bumping up against this so-called reversal rate, where actually negative rates start to do more harm than good.
Peter Rustaway with us on Bloomberg Radio and Bloomberg Television. Welcome all of you to our simulcast this morning. Lisa Bramwitz, Jonathan Farrow, and Tom Keene. We're looking at the markets tick by tick. We'll get to that when we're done with Dr. Westaway. Right now, all you need to know, futures negative 46. It is pretty tough out there this morning. Dr. Westaway, to sum all this up, and when you look at the fiscal policy right now, it comes back to aggregate demand. We're seeing in oil this morning a real global issue of demand. Would you suggest that demand is threatened into Q4?
Well, I think the big question in Q4 is really the same question we've had for the last 6 months, which is what's going to happen to the virus, what's going to happen to the policy, the consumer response to that. And at the moment, consumers, firms are still very tentative about going out and spending money. And so we do have this aggregate demand shortfall, which is where the fiscal policy is piling in to try and replace that spending. And really, it's a bit different, this fiscal policy support, because what it's really doing is it's providing income to people who are out of work. So it's not so much about getting people out spending money that they otherwise wouldn't have spent. It's actually just propping up their income. And as long as people are out of work or on furlough, there's going to be a need for this. So next year, as it easily could, is it really feasible that governments will carry on giving this exceedingly generous income support to workers who haven't yet got back into work? I think they're going to have to, but it's going to really put a strain on the dead.
Peter, great to catch up. We've got to leave it there. Peter Westaway there of Vanguard. We are 51 minutes away from the opening bell in New York City, and the price action cross-asset worldwide shaping up as follows. NASDAQ futures right now down more than 3%, just off session lows. A breakdown that started about 4 Eastern. We're down 370, negative 3.2%. And you just see that risk aversion, cross-asset into the FX market. Stronger dollar, euro dollar south of 118 in the bond market. Bid at the long end, yields lower, 5 basis points, a 10-year 0.67%. And a rout in the commodity market. Tom, crude with a 37 handle. We're down almost 6%.
Crude's not a small item with Brent crude. That global price, $40.47 per barrel. John, I'm looking also at something that's linked up in the last half hour or so, and that is the Standard & Poor's 500. This is a different index dramatically than the NASDAQ 100. I'm not sure if we have that chart for Bloomberg Television. I'll get it out for Bloomberg Radio. But, John, we're really beginning to break down off the recent lows that we saw on the S&P futures.
It will be tough to see a rotation in today's session, given the bond market action, Tom. A flatter yield curve. I think if we saw higher yields today, coupled with tech lower, the financials might do some of the lifting. You might see some of the cyclical elements of the market doing some of the lifting. But right now, with Apple, which is a massive weighting, of course, on the NASDAQ 100, about half of the weighting on the S&P, given the broader index, but still a big weighting, down 5.5% in the pre-market. It's going to be a big drag on the S&P 500 as well.
And, John, I want to review here. I think this is so important, folks. Just the basic idea that SoftBank widely presumed to buy a lot of call options, and then the dealers they deal with have to react to that with derivative hedges. And then when the trade's over, you have to unwind the hedges. Is SoftBank hopefully unwinds a trade? And Lisa, as you mentioned in an early morning note, this is before Farrah was out of the gym. Lisa, you mentioned this morning that SoftBank equity shares have already been hit hard, even as they try to unwind this success.
And even though they've actually posted a profit, according to the Financial Times, on their positions, they're still getting hammered by people who are concerned about what they are. I'm struggling, though, to find a narrative that really explains today's action. Perhaps that's why people are blaming SoftBank, John.
Don't look for one, Lisa. Maybe that's the lesson of the last month or so. Seriously, just don't look for one. So many people spent the whole month of August trying to come up with reasons for why the market was higher. And I think the last week has just embarrassed everybody who did have this strongly held belief as to why things were higher. Equity futures down a little more than 3% on the NASDAQ. Yeah, that dollar weakness not there this morning, Tom. This is Bloomberg Surveillance.
With the First Word News, I'm Kaylee Lyons. Bloomberg has learned that Donald Trump is considering an unprecedented step for an incumbent president. He's discussed spending as much as $100 million of his own money to win the election. The president has been scrutinizing heavy spending by his team earlier this year that failed to push him ahead of Biden. Plus, Biden's campaign and other Democratic entities have outraised the Trump campaign in recent months. Meanwhile, President Trump is threatening to curb the U.S. economic relationship with China, and he's promising to punish American companies that do business there. The president's calling on those firms to be banned from getting federal contracts. He also wants to impose tariffs on companies that leave the U.S. to create jobs in China and elsewhere. President Trump said that if Joe Biden is elected, China would, quote, own the U.S. In California, the electricity crisis has gotten worse. The state's biggest utility says it expects to cut power to 500,000 people this week to prevent live wires from sparking wildfires. Last week, the problem was a heat wave. This week, California is expecting high winds to come sweeping off the Pacific Ocean. And Kamala Harris made her first solo campaign trip as the Democratic vice presidential candidate. She went to Milwaukee, where she appealed to communities of color that will be crucial to winning the battleground state of Wisconsin. Harris met with black business owners as well. She also talked with Latino activists who advocate for frontline workers. Global news 24 hours a day, on air and at TikTok on Twitter. Quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lines. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on so you can keep on.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
economists are starting to call this recession a K-shaped recession, which is a fancy phrase for what's wrong with everything about Trump's presidency. The K means those at the top are seeing things go up, and those in the middle and below are seeing things go down and get worse.
Joe Biden, Democratic presidential nominee over the weekend, and a shout out to Peter Atwater as well, who I think messaged me several months ago talking about the K-shaped recovery, and that was the first time I'd come across the concept. I think we had an economist from Berenberg in the last day saying how much we've abused the alphabet as far as this recovery is concerned, Tom. On the tech sell-off, Dan Ives of Wedbush, a conversation you don't want to miss, 9:30 Eastern, Bloomberg TV, the countdown to the open commencing in 12 minutes' time, Tom. Looking forward to that.
Really looking forward to that, and that dovetails into what Chris Marenghi said, is keep your eye on the fundamentals. Okay, so we've corrected, or maybe if you have no sense of history, you'd call it a correction, but maybe it's not. So on radio and television right now, we're going to frame all of this with Barry Ritholtz. We can do that not only with his wonderful book of years ago, what he's writing for Bloomberg Opinion and on his podcast, but Ritholtz with a great sense of history as well. Barry, I want to go to Nassim Taleb in the wonderful character Nero Tulip in his book Fooled by Randomness, who's completely taken in the opening of the book by the red Porsche the guy is driving. We have had a red Porsche market. Everybody's been able to afford red Porsches with the market up and away, and we nudged down 5 or 6%, and the world's coming to an end.
Numbers on that. Since all of this energy, or most of this energy, has been taking place in the big tech stocks, let's use the NASDAQ 100 as an example. In the March lows, it was barely over 7,000, and it peaked in August at 12.4 and change. That's about a 77% rally in less than 6 months. So straight up for 77%, I think a 10 or a 15 or even a 20% pullback is certainly overdue. And profit taking is probably the most abused phrase in all of finance. But in this case, it could legitimately be people who bought in March, April, May saying, all right, I got a huge profit. Maybe I should ring the bell and take a little something off the table.
Barry, do you buy that SoftBank is causing the sell-off?
About as much as I buy the fact that Robinhood was driving the market in the first place. Look, they're $100 billion funds. Most of that money is tied up in pretty illiquid long-term investments. So if they want to fool around, for lack of a better phrase, with a couple of $1 billion in options and derivatives, they could move a handful of stocks for a little bit, but that ignores the fact that you've just had a massive move across a lot of big companies that are actually doing well during lockdown. Right. They're doing well because they have global exposure, and they're doing well because they were built for work from home pandemic circumstances. So I'm not buying the SoftBank whale story at all.
Okay, so here's the question. I was asking John, I said, I'm not seeing a narrative here. What's the narrative? And he said, don't look for one. There hasn't been one. August was the problem when people were trying to find one. That's what we've learned. And here we don't really have a cohesive narrative to explain it. It's more randomness, to your point, the fallacy of a narrative. And yet, what undermines this idea that you buy the behemoths, you buy these cash fortresses that will continue to do well in a tech-driven economy? Why not just buy now, given the fact that they've come off? I mean, have we really upended our questions about how to fundamentally value these companies?
That's a really challenging question about valuation for a couple of reasons. Clearly, valuations have gotten extended. And the prior narrative, the prior narrative before the whale narrative, was stocks and investors are looking over the valley of 2020 to the recovery in 2021, or perhaps 2022. One of the few narratives that makes sense is Tesla was running up in anticipation of being added to the S&P 500. And when that didn't happen because of supposed profit and revenue reasons, that sell-off, okay, I can accept that. I could buy into that argument because there was no indexing coming in to make up for the lack of purchases. But the problem with narratives, especially after the fact, hindsight biased driven narratives, is they ignore how random so much of the market action is. Right. And if it was easy and predictable and foreseeable, well, hey, we'd all be wealthy. But the randomness is what makes it so challenging. And people who are uncomfortable with randomness spend a lot of mental and emotional energy looking for a description and a storyline that makes them comfortable. Humans are terribly uncomfortable with random outcomes.
Barry, one of the great things here in the derivative markets, and again with SoftBank, is if you issue the call, there's the put, et cetera, you know, the right against the call. Fine. Do you just assume there will be losses if SoftBank takes a gain of X billion dollars? Do you just assume there's a prescribed sum loss against it by global Wall Street?
Trading is essentially a zero-sum gain. So for every winner in a trade, there's a loser. The exception being not the traders, but the investors who are allowing compounding and the passage of time to work in their favor. If someone sold something at 10, 20 years ago, and today it's being, the person who bought it is selling it at 200, that's not exactly a zero sum. But if I'm a buyer and you're a seller, and then tomorrow I'm a seller and you're a buyer, net, that's going to flatten out to zero minus whatever the trading costs are.
Wisdom, Barry Ritholtz, can't wait to see you write on this. Barry Ritholtz writing for Bloomberg Opinion, of course, and with Ritholtz Wealth Management as well. Lisa, on SPX, we're down testing new lows. We'll see if we get there. We'll have it for you on Bloomberg Radio and Bloomberg Television. Down 3% on NASDAQ. And you know, I look at the motion this morning, and it's highly unusual, Lisa. It's well contained, and yet a set of lower lows and lower highs.
Yeah, and you talk about contained, it's contained to several names that are leading the declines. Yeah. Tesla shares down more than 14% in pre-market trading. Apple shares down 4.5%. Amazon down almost 4%. Again, this raises a question. How do people fundamentally value these companies at a time when they do have very solid balance sheets, and yet they have been bid up so much, Tom?
Well, we'll end up on the performance of the companies, and we'll see that as we get through earnings. Yeah, if we get through earnings and we get through conference calls, there'll be a reaffirmation of those stories if that is the case. I'm not giving an opinion.
Well, but my question is, does that justify where valuations are if they give that solid cash flow?
The market justifies where they are. I quoted Paul Samuelson this weekend from 1948, folks, on a bull market makes its own hopes. I'm paraphrasing there as well.
Said.
It's good in this hour to end with Paul Samuelson, the original laureate. Please stay with us through the day. On Bloomberg Radio, on Bloomberg Television, we will cover this market turmoil. This is Bloomberg. Good morning.
see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From London and New York, for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell, with equity futures breaking down in the last 4 hours. NASDAQ futures down almost 3%. We begin with the big issue. Summer is over.
We've seen a big rotation out of the technology companies.
The tech routes towards the end of last week.
No one knows exactly what's driving it.
Short-term froth coming out of that market.
About a profit taking after what's been a pretty remarkable rally.
A slowdown in the pace of the recovery.
We don't know when we're going to get another fiscal stimulus package.
Volatility comes back in because of the election.
Whether or not the tech trade is over, I'm not so sure.
US equity outperformance has been driven largely, against other countries, been driven largely by tech.
Liquidity is still plentiful.
The rotation towards more cyclical stocks may therefore be overdue.
There's going to be headwinds for them.
Tech actually accounted for more than half of the overall inflows.
I wouldn't be chasing a cyclical rotation.
What a start to the trading week in the United States this Tuesday morning. Let's get the price action on the screen. Equity futures breaking down by around about 2.8% on the NASDAQ 100. With the moves is Scarlett Fu. Hey, Scarlett.
Hi, John. Well, technically it's still summer for another 14 days, but it doesn't feel like it because with the tech sell-off, we get a stark reminder of all the worries that investors face as we approach the end of the third quarter. The market's biggest winners finally seeing a pullback after defying gravity for so long. The NASDAQ set to underperform the broader market for a third straight session. That rally got extended and it masked a lot of the other risks lurking out there under the surface. There's still no fiscal deal, first of all. Congress arguing over the fiscal stimulus. We got the latest jobs report and it showed an addition of 1.4 million jobs in August, but we saw a steady increase in the number of people who are unemployed permanently. Since the start of the pandemic, a lot of companies were furloughing workers so they could collect benefits. Look at the airlines, for instance. They say without more government aid, those cuts could become permanent. We're also dealing with election risk. We're 56 days out from the election. The rhetoric is heating up, especially when it comes to U.S.-China relations. And of course, we got a taste of it this morning. President Trump considering a ban on cotton imports from the Xinjiang province of China. Volatility markets, as you can see, pricing in larger moves in stocks. The October futures contract, that's the white line, covers the election, and it is more elevated than the other contracts. And of course, finally, with apologies to the Starks, winter is coming because being stuck indoors and the flu season coming back, that means another wave probably of the coronavirus. An approved vaccine doesn't change the outlook either because it'll take time to scale and distribute the treatment. John?
Scarlett, looking at the price action today and the moves through August, many people looked for that narrative to explain what happened in August, and now I imagine a lot of them feel embarrassed given what we've learned in the past week or so. Can you reduce the moves we've seen, not just in the last couple of days, but in the last month, just to SoftBank behaving like a hedge fund?
I mean, there's a temptation to do that, but it's probably too simplistic. SoftBank was probably one of many investors who plowed in to the market and piled in on the call options, those bullish options, but it probably wasn't the only one. We know retail investors were pretty hot and heavy into those big cap tech names
early on in the recovery in March, in April, and in May. So someone like SoftBank, a potential NASDAQ whale, probably exacerbated the situation, but probably isn't responsible for all of it. That's just my take. We're, of course, still trying to find out more information about this, but that would be the early read.
Scarlett, thank you. We'll catch up with Scarlett a little bit later this hour. 27 minutes away from the open and bound. Equity futures breaking down. NASDAQ 100 futures down by 2.9% off session lows, but still down and down hard. The move started about 4 a.m. Eastern, and we have just gone lower, lower, lower over the last few hours. Looking forward, Chad Morganlander of Washington Crossing Advisors staying underweight growth and tech stocks, writing the following. Valuations on leading tech names are overextended. Investors are torturing the numbers to make the math work and justify their price targets. One should look towards high-quality value companies as a reasonable investment choice. Chad joins us now for more. Chad, this is the story for me. Trying to justify the unjustifiable became an industry in and of itself in the month of August. Are we doing it again?
Well, it's based off of a similar 1999 market move. And you have just a handful of really good companies, but the valuations are absurd. And what's happening is analysts are taking out their expectations out many, many years. So, okay, you got a great company, low debt on the balance sheet, but they're artificially inflated. They just need to be revalued lower. So we're advising investors to look at other types of sectors like industrials or healthcare, and to just not sell the market off altogether, but just be a little bit more pragmatic with the investments that you're making and the expectations you're making in the later years.
Well, Chad, let's split up your argument into two. The first point, that some of these names in the tech space have been overextended and we need more realistic valuations. The second point being where you want to put your money, and that's elsewhere. On the first point, what is the appropriate multiple on a company that in a complete shutdown in many parts of the world economy managed to mint money? In a world of zero rates, what is the appropriate multiple on that company?
Well, you know, it all depends based off the growth rate and the predictability of that free cash flow. But going out 2 years and having a multiple in excess of 40 or 50 times, to me, is a little bit too high, especially when you could see very good quality companies in the industrial sector post-pandemic that are trading at market multiples or 10 or 11 with very little debt that should do quite well, that have tremendous earnings potential 5 years out. So again, these are not bad companies, the ones that they've marked up. But yet, you know, you're at nosebleed territory, so we're advising investors to trim that back. You don't have to sell everything, but to trim that back and to start to cycle into some more companies that are more sensible from a valuation perspective.
One single name getting a ton of attention this morning. Apple down by 4.6% in the pre-market. On the year through 2020, up by about 65%. An Apple bull, Dan Ives of Wedbush, joining us a little bit later this hour. Let's talk about elsewhere. Chad, it's going to be a difficult morning for the market, with tech doing what it's doing and the bond market doing what it's doing. And I'm thinking about the financials at the moment. How do the banks start to get a new lease of life in America with rates where they are, Chad?
Well, the story there is about the behavior of the yield curve. And if you're looking out a year and a half and your base case scenario is that the economy will continue to improve based off of a solution regarding the healthcare solution on a global basis, then you should see a modest steepening of the curve, which would be a great tailwind for financials. That, to us, is one that you have to keep a careful eye on. Also, as well, look at the industrials like I just mentioned. We're setting up the portfolio, John, for a post-pandemic reality. And to be a little bit more pragmatic about growth trajectories, I think is important, especially with these high multiple stocks.
What do you think a post-pandemic world looks like, Chad?
So we're setting up our book in regard to buying emerging markets. We haven't been buying emerging markets for the last 3 years. Anytime I come on your show over the last 3 to 4 years, we've always said we're drastically underweight emerging markets or not in. Now we're overweight EM, we're overweight developed, we're underweight dollar-denominated assets here in the United States, though we do believe that high-quality companies there are seams of opportunity here in the United States. This is what we're doing, as well as we've dropped our duration on the fixed income side below our benchmark, because we do believe over the next 6 to 9 months, you could see a modest normalization of that curve.
What is it about the trade story at the moment, Chad, that is not denting the appetite, the enthusiasm for EM, for Asia, for industrial names? If this was 2018 going into 2019, we'd be having a very different conversation after the address the President of the United States gave in the last 24 hours. What's changed?
Well, our belief, again, is that, valuations, when you look at it from a comparative perspective, they're grossly undervalued. 2, we believe that the dollar may modestly soften based off of monetary policy. And 3, I think that the trade issues that right now are front and center will pass over the next 6 to 9 months. And the growth dynamics within emerging markets, we believe, based off of comparisons to developed as well as the United States, are materially more attractive over the course of the next 3 to 5 years. So again, we're now overweight the EM side. Another thing is that we do believe our base case is that this healthcare crisis will slowly start to resolve itself over the next 12 months. And as that becomes more clear, we think that these seams of opportunities will become more attractive.
Hey, Chad, great to catch up, as always. Chad Morganlander there of Washington Crossing Advisors. Coming up on China, on the United States, President Trump vowing to scale back economic ties with the country. That conversation coming up next with Morgan Stanley's Matt Hornback. Your price action this Tuesday. What a start to the trading week, with equity futures down and down hard. NASDAQ futures off by 350, negative a little more than 3%. The pain concentrated in big tech, bringing S&P 500 futures down 46, negative 1.35%. 20 minutes away from the opening bell from London and New York. This is the countdown to the open.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We'll end our reliance on China once and for all. Whether it's decoupling or putting in massive tariffs like I've been doing already, we'll impose tariffs on companies that desert America to create jobs in China and other countries. If they can't do it here, then let them pay a big tax to build it someplace else and send it into our country. We'll prohibit federal contracts from companies that outsource to China.
President Donald Trump coming out swinging in the last 24 hours, increasing his anti-China rhetoric ahead of the election as the U.S. considers a ban potentially on importing Chinese cotton. Bloomberg chief Washington correspondent Kevin Cirilli reporting the following. China's treatment of its Muslim minority group has provoked an international outcry. Relations between the United States and China have deteriorated over Xinjiang and other issues, including the crackdown on pro-democracy advocates in Hong Kong, territorial disputes in the South China Sea, and recriminations over the spread of the coronavirus. I'm pleased to say that Kevin joins us right now. Kevin, fantastic reporting as always. What have you learned?
Well, three things. First and foremost, that key quote yesterday from President Trump, the word decoupling, I'm told is going to be very much in the jargon of what administration officials and economists at the White House are going to start using, forecasting to U.S. supply chains that there is a dramatic reshifting that is occurring between U.S. and China supply chains that are likely going to be rerouted in the long term. Secondly, as it relates to textiles, I'm told by administration officials that textiles, the president really is considering issuing a ban as it relates to the cotton industry in the Xinjiang province. That, of course, is where predominantly the alleged minority abuses against the Uyghurs is occurring. And finally, all of this is coming with the backdrop of the 2020 presidential election, where China is front and center at the geopolitical debate. Expect to hear more from Biden's presidential campaign on how a Biden administration would seek to use European allies in order to further isolate China economically.
Fiscal policy, a big part of the conversation down in D.C. as well, Kevin, not just the latest effort on China. Getting a headline crossing a Bloomberg right now from the German finance minister saying that Germany needs to take on significant debt in 2021. They will be back in line with debt rules in 2022. This is the story over in Germany. There was a thought that maybe they shifted to a new normal. I'll talk about this with Matt Hornback and Morgan Stanley in just a moment. For the United States, Kevin, I put the question to Larry Kudlow, the National Economic Council Director, if they were comfortable without a fiscal deal before the end of this year going into the election. Take a listen to what he had to say.
A bad package would not be helpful. A smart, good package, well-targeted, would be helpful. Do we absolutely need it? No, I'm not going to precondition anything here. What's good is good independently. What's not good is not good independently. Right now, the economy is on a self-sustaining recovery path, in my judgment, and we'll continue along those lines, and we'll continue to surprise on the upside.
Kevin, I pushed him, and he said we can live without it. Do you get the sense that the conversation you and I have had for the last 4-6 weeks has shifted? That we used to say it's a matter of when, not if, that maybe it's a matter of if it actually happens now.
You know, I think based upon my reporting, I think it will definitely still happen. And to that point, if you look at the trade balance, for example, between the U.S. and China, which actually in the Bloomberg terminal, it shows that it's expanding as the trade is picked back up again as it relates to the reopening of the economy. But what you just heard from Larry Kudlow in your interview is really in stark contrast to what Fed Chair Powell has been saying, as well as Randy Quarles. I mean, there's this whole notion that there has to be some type of stimulus. But when that stimulus happens, whether it's after November 3rd or in December or January, it is still a matter of when, because they're talking about infrastructure. The Democrats are talking about infrastructure and the like. So it might not happen before November 3rd, but there still likely will be a massive government spending package sometime within the next 6 months. That's the expectation, even amongst Republicans and Democrats still, just likely not, maybe not before the election.
How many days away to this election, Kevin? Do you have a countdown clock in the Washington, D.C. Bureau?
No, November 3rd. Sorry, 2 months. Sorry, but I should.
Kevin, I respect you more for not having a countdown clock. I really do.
I take it one day at a time.
As always. That response should be a meme. Kevin, fantastic to see you, as always. Morgan Stanley expecting a flight to safety surrounding the U.S. election, saying the following: before election results appear with certainty, we expect risk appetite to be low among investors, which will likely keep a bid for U.S. Treasuries. The more time it takes to get a result with certainty, the flight to quality bid could increase. Morgan Stanley's Matt Hornback joins us right now. Matt, great to catch up with you, sir. Just build on that a little bit more, what you're looking for in the next couple of months.
Thanks, John. Well, so obviously the election is an event on investors' minds, and so we did some work to try to understand when we might actually know the results from the November 3rd election. And it seems to us, based on the surveys that we've done, that a base case of knowing who the victor will be on November 3rd seems a bit optimistic. So we're expecting to know the result, certainly in the week of the election, but perhaps not on election night or early the following morning. And historically, when you have a situation like this, doesn't occur very often, if only one time in recent memory, risk markets responded poorly. Of course, you go back to what happened in November of 2000, and you see very clearly that in the wake of the uncertainty surrounding that election, investors expressed that by reducing risk exposure in equity markets, clearly caused a bit of a flight to quality into the treasury market. And so, that's something that we're looking at right now, John.
Well, Matt, let's build on that. The flight to quality and whether treasuries are still a part of that story. And in the words of Mohammed Al-Arian, offer you those risk mitigating characteristics that you might want in a risk drawdown. On the screen right now, 10 minutes away from the opening bell, equity futures on the NASDAQ, negative 3.2%. And we do have a bid into the bond market. Treasury yields are down around about 4 basis points on 10s, down 6 basis points on 30s. Matt, as far as you're concerned, looking at treasuries right now, will they continue to offer what they have typically always offered when risk assets do poorly?
I believe so, John. I think we saw this very clearly back in March, not necessarily in the Treasury market, although, of course, Treasuries did very well. The starting point was from a much higher yield level than we have today, which is, I think, to your point. But when we looked at, let's say, the German Bund market back in March, German Bund yields started out extremely low and went even lower. In fact, the 30-year German Buxel traded down to its overnight financing rate. In other words, people were not only willing to accept a negative yield at that time, but they were willing to accept a negative yield below its overnight financing rate, which meant that there would be no carry for a levered investor into that paper. So, the corollary in the Treasury market would be akin to the 30-year Treasury going from 1.4%, which is where it is today, down to about 12 basis points. So that 100 basis point decline in the 30-year Treasury yield would offer you a total return in the context of 17, 18%. That will go some ways to mitigating any type of bear market in equities at this point. So I do think that longer duration treasuries will still offer you that protection.
I asked this question, Matt, because I'm sure you're experiencing it in conversations right now. It seems to be the topic of the moment. The 60-40 portfolio might be the portfolio of yesteryear and something needs to replace it. Subhadra Rajappa of SocGen said, that story's over. I'm trying to think about potential substitutes, Matt. I understand your call that treasuries will remain that story, but when you have this conversation with clients at the moment, worried about the risk side of the portfolio and thinking about what to put on the other side of the barbell, so to speak, Matt, what does that conversation sound like? What are they reaching for? Is it just cash? Is it something else?
Well, no, I mean, the next place that we look to, and I think investors do as well, are the currency markets. And, the natural place to start is what currency tends to perform well during episodes of risk off. And, that you would turn to things like the US dollar, the Swiss franc. And so investors do look at those currencies. They also run correlation analysis to try to understand historically what type of assets perform well when risk markets perform poorly. The problem ultimately with correlations is that they change over time. And so, of course, when you're trying to put on a position to mitigate risk using correlations, sometimes it doesn't behave as it has in the past. So in our view, though, treasuries will continue to remain a good risk-off hedge. We also think that the U.S. dollar would perform well in a scenario in which we did not know the results of the election for some time. So there still are ways for investors to mitigate risk, we think, in the traditional assets today.
Hey, Matt, good to catch up. What a morning for it. Matt Hornback there of Morgan Stanley on the other side of the portfolio with risk falling out of bed this morning. Coming up, the analyst action you need to know. That'll be next in our morning calls. And later, Dan Ives of Wedbush explaining why he's staying bullish on big tech amid the rout of the last couple of days. NASDAQ futures down 3.3%. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
There is a rout ahead of the opening bell. On the S&P 500, we are negative around about 52 points, call it 53. On the NASDAQ, we are down by 3 percentage points and change. We're down hard. Let's get some morning calls, shall we? Look at some of the analyst recommendations on Wall Street this morning. Your first one comes from Goldman, downgrading Wynn Resorts to neutral, a $95 price target. The analyst signing its outsized exposure to Macau. Your second call this morning from Bank of America, upgrading Alcoa to a buy, a $17 price target. The analyst expecting earnings to increase to top expectations due to her positive outlook. And Evercore upgrading Ford to inline with an $8 price target. Three of the calls, the opening bells next.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
The investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
Coming off the back of the first weekly loss since July, we are adding to those losses this morning. S&P 500 futures down 52, negative 1.5%, but there's the pain, the epicenter of it. Big tech, NASDAQ futures down by 3.4%. Switch up the board, it is risk aversion bleeding through every single asset class worldwide. Into the bond market, a bid on 10s, yields lower by 4 basis points to 0.68%. In foreign exchange, a stronger dollar against the bulk of G10, euro dollar south of 118 at 117.83. We are in 1/3 of 1% on that currency pair. And in the commodity market, there's a route for you. Negative 7% on WTI. We trade with a 36 handle just south of $37. That's the cross-asset price action this Tuesday. Let's get to the market desk and get you some movers. Here's Abigail.
John, the tone is risk-off enough this morning that we're seeing something relatively unusual for stocks that are being included in the S&P 500 on the quarterly rebalance, and that's slightly popping higher for one stock, and then we're also having some declines. But the big mover, of course, Tesla, down 15.5% on the fact that the company last Friday, the news came out that they will not be included despite meeting some of the criteria. Now, of course, that stock up about 600% from the March trough to the recent peak. So you could say that the 30% drop from that recent peak, healthy consolidation, the idea that they were going to be including the S&P 500 might have been baked in. Sellers really stepping in now that they're not. As for the stocks that are being included, Etsy, Teradyne, and Catalent, you can see not really a bullish response. That's how risk-off it is on the day. However, turning to another electric vehicle maker, Nikola, the shares are absolutely soaring, up 29%. This on the news that GM is taking a $2 billion stake. That stock is up higher as well, up 5.3% on the partnership around an electric truck, and the idea here that the company's really moving into the modern future here with electric vehicles, a big step. To the downside, though, this morning's big player, Microsoft, actually down 3.4%, in line with the tech sell-off, and with Apple trading lower as Goldman Sachs is reiterating their sell rating, saying that the valuation simply is not there for the growth, which you can make the case has been the truth since August. That stock at greater than decade-high valuation multiples. And finally, John, Zoom, last week's best stock, even with last week's tech rout, down 20% today, feeling some of the pain, down 4.6% on the year, up 443%. It's very clear that you have these tech and stay-at-home stocks selling off hard once again, John.
Abigail, thank you. Thank you very much. Abigail Doolittle will be back with us a little bit later to give you the sector composition of this breakdown. Let's lift the lid on the S&P 500. 2 minutes into the session, your equity market down by 1.86% on top. Your relative outperformance, of course, coming from the utilities, given the bid we see in the bond market this Tuesday at the bottom. Widely expected, anticipated once again, negative follow-through after the sell-off on the back end of last week. Big tech, IT, down by a little more than 3%. Speaking of down 3%, that's been the story for the NASDAQ all morning. The S&P is lower, the NASDAQ is much lower. The NASDAQ down by 3.3%. Tech getting hammered after being one of the top performers through much of this year. UBS's Stuart Kaiser expecting the declines to be short-lived.
We still think large cap tech leadership, or what we would call selective cyclicality, is sort of the way to be positioned. And this is probably a shorter term disruption for the markets. But, I think you need to respect the fact that we've seen in 2 weeks, 1.6 million contracts added in the big 5 tech stocks, and 70% of that's been in call options. And when that kind of flow goes through the system, it's going to impact the way markets trade.
Joining us, back with us, Bloomberg Scarlett Fu. Hey, Scarlett.
Hi, John. Yeah, all that options activity may be coming home to roost here because over the weekend, the Financial Times identified SoftBank as the NASDAQ whale. That is a large investor with the money to single-handedly move the price of an individual security or group of stocks or even the market. And the whale is often exposed when it becomes apparent that they move the stock in a negative way. According to the FT, SoftBank spent $4 billion over the past few months buying options on the biggest tech names. Now, to be sure, one institutional investor is still relatively small when you compare it to the army of retail investors who've been plowing into call options. According to another estimate, individual investors have shelled out $40 billion in call premiums in a month. That would be 10 times what SoftBank reportedly spent. So do call options drive the underlying stock prices higher? That's a big question, and my colleagues Joanna Yossinger and Jakob Petersil spoke with a hedge fund CIO who says it depends. It depends on who's doing it and how they do it. Now, institutions